On a cold morning in January 2024, when the global markets were still recovering from a chaotic holiday season, something strange happened on the metals exchanges. For a brief moment, silver inventories at the main New York futures market slipped to a level not seen in more than 6 years. It was a small numerical change, almost invisible to casual traders. But to those who understood market structure, it was the kind of signal that does not appear in normal conditions. It was the kind of signal that appears only when a long, suppressed truth begins to surface. That moment was not an isolated anomaly. It was a flare in the dark, the opening crack of a story that has been building for 4 decades. The story that silver, one of humanity's oldest monetary metals and one of industry's most essential materials, has been mispriced on a scale that history rarely tolerates. And that mispricing is now entering its 3rd stage, the stage where pressures finally converge, where balance sheets cannot hide reality, and where systems begin to break before they reset. To understand how we arrived here, we need to begin with a single ratio that quietly governed global monetary systems for almost 2,000 years. From the Middle Ages through the 19th century, the natural exchange rate between silver and gold stayed remarkably consistent, hovering between 12 to 1 and 16 to 1. When the United States established its Coinage Act in 1792, it set the ratio at 15 to 1, in line with global norms. Through the 1800s and early 1900s, the ratio fluctuated but still respected the historical band. 14 to 1, 16 to 1, occasionally 17 to 1 in times of stress. Even after the Gold Reserve Act of 1934, the ratio widened to around 30 to 1, but remained tethered to fundamentals. Then came 1971, the year when President Richard Nixon closed the gold window and ended the Bretton Woods monetary system. Gold was freed, silver was freed. Markets were suddenly allowed to discover price. For a short moment in 1980, they did. When silver surged to its all-time high of $49.45 per ounce, the ratio collapsed back to 14 to 1, exactly in line with 2 millennia of natural equilibrium. And then, as if someone pulled a lever, the pattern broke. Not temporarily, not for a cycle, but for 40 years. Today, the silver-to-gold ratio sits not at 15 to 1, not at 30 to 1, but at 80 to 1, and often 90 to 1. This is not a deviation, it is a rupture. To put it plainly, if gold trades near $2,400 per ounce, the historical ratio implies silver should be around $160 per ounce. That is almost exactly the inflation-adjusted value of the 1980 peak, which sits between $150 and $180, depending on the index used. Silver has not returned to that real value once in more than 4 decades. Meanwhile, gold has broken its inflation-adjusted all-time high. Oil has moved through multiple supercycles. Copper, nickel, and almost every industrial metal have set new real highs. Even real estate and broad stock indexes like the Standard & Poor 500 have multiplied several times over since 1980. Silver alone has remained stuck under $30 to $60, far below its real peak, as if time itself refused to let it move. A pattern like this does not survive for 40 years by accident. Structural forces keep it in place. And this brings us to the second layer of the story, the divergence between the real physical market and the enormous paper market that prices it. In the modern system, silver is not priced by the bars sitting in vaults. It is priced by futures contracts, options, synthetic exposure products, and layers of leveraged paper instruments. For every ounce of silver that exists in registered vaults, there may be 100 ounces of paper claims trading above it. This imbalance is not theoretical. The main futures exchange often shows registered inventories of only 50 to 60 million ounces. Yet, daily open interest can represent billions of ounces on a notional basis. When paper volume overwhelms physical availability, liquidity, not scarcity, determines the price. True supply and demand become muted beneath waves of synthetic exposure. This is why the fundamental signal of the last decade has been so alarming. Even as inventories drained by more than 60% from 2020 to 2024, even as London vaults fell to multi-year lows, even as refiners and mints reported shortages of blanks, the price barely moved. In a normal market, multi-year deficits would force higher prices. In silver, those deficits have been absorbed by the paper system, delaying the inevitable but deepening the eventual shock. And the deficits are real. From 2021 to 2024, global silver markets have run persistent shortfalls, roughly 50 million ounces, then 180 million ounces, then around 140 million ounces, and once again near 150 million ounces. Meanwhile, global mine supply has been flat at around 820 million ounces for more than a decade. Many mining companies report an all-in sustaining cost, the full cost of producing silver, between $16 and $22 per ounce. In harder geological environments, the cost can reach $25 to $30 per ounce. When spot prices trade near $22 to $25, mining margins collapse. New exploration slows. Marginal mines shut down. And because 70% of global silver comes as a byproduct from mining other metals like lead, zinc, and copper, production cannot easily increase even if prices rise. Supply is inelastic. Demand is not. Which brings us to the Industrial Revolution happening quietly beneath the surface. In 1980, industrial demand for silver represented maybe 10 to 15% of total use. Today it is more than half, 54 to 56%, and rising. Solar photovoltaic manufacturing alone is projected to consume more than 200 million ounces by 2026. Electric vehicles, sensors, robotics, artificial intelligence hardware, medical devices, and global 5G infrastructure all rely on silver's unmatched conductivity. There is no true substitute. Copper and aluminum do not come close. And unlike gold, which is almost never destroyed, silver used in industrial applications is often lost permanently. Only 15 to 20% is economically recoverable through recycling. More than half of the metal mined each year will never return to the market. This creates the kind of structural tightening that should have forced a repricing long ago. Instead, the price has remained compressed, a spring held under continuous pressure. History gives us several warnings about what happens when monetary metals disconnect from fundamentals. In ancient Rome, the denarius was gradually debased over centuries. The silver content fell, but the empire pretended the coin still held its original value. Reality eventually broke through, and the currency collapsed. In 16th century Spain, vast shipments of New World silver flooded Europe, creating distortions in trade, price levels, and power structures. When silver flows slowed, the imbalance created decades of turmoil. In 20th century Britain, the pound sterling clung to its global dominance long after the fundamentals had eroded. Once markets realized the mismatch, the decline was sudden and irreversible. And, of course, there is the famous 1980 episode of the Hunt brothers, who attempted to corner the silver market. When regulators changed margin rules, prices collapsed. But beneath that dramatic story lies a quieter truth. The reason silver could be cornered at all was because the physical supply was already tight. The attempt failed, but the scarcity signal was real. And 12 years earlier, when Nixon closed the gold window in 1971, he was reacting not to ideology, but to the unavoidable arithmetic of a system that had drifted too far from reality. We have seen this pattern across civilizations and across centuries. A long period where official pricing diverges from fundamentals, followed by a moment when the divergence becomes impossible to maintain. These transitions do not unfold smoothly. They tend to happen in stages. Stage 1 is denial, when markets assume the imbalance is temporary. Stage 2 is containment, when institutions lean on every tool they have to preserve the old equilibrium. Stage 3, the stage we are in now, is the quiet acceleration phase. Inventories drain, deficits expand, derivative structures become fragile. Industrial users begin to secure supply through long-term contracts. Major countries tighten export controls. Central banks and corporations accumulate quietly, while the public remains distracted by headline prices that appear calm. Stage 4 is the break. Stage 5 is the repricing and reset. Every signal today points to the fact that we are deep into Stage 3. Mexico, one of the world's largest silver producers, has begun to oversee exports more carefully. China has reduced public reporting of its silver flows, a pattern historically associated with strategic accumulation. Solar manufacturers are locking in multi-year contracts to guarantee silver access. The United States Mint has repeatedly warned of shortages of silver blanks for coin production. London inventories continue to fall. And the silver-to-gold ratio remains at a level not seen at any sustained period in the last 2,000 years. If silver were merely drifting, we would expect random fluctuations. Instead, we have an aligned pattern, a uniform direction, and a 40-year compression that is becoming mathematically unsustainable. This is why the mispricing thesis does not rely on emotion. It relies on hard arithmetic. Silver is the only major metal trading below the inflation-adjusted price of 1980. It is the only essential industrial metal whose supply cannot scale with demand. It is the only monetary metal whose price is primarily determined by leveraged paper markets rather than physical scarcity. It is the only asset that plays a dual role as both currency and irreplaceable industrial resource. And it is the only commodity where inventories fall year after year while the price barely moves. None of this guarantees an immediate break. But it does guarantee that the pressures are real, and that pressures like these do not sit quietly forever. Market structures can delay truth. They cannot erase it. The historical record is clear. When mispricings persist for years, the adjustment is sharp. When they persist for decades, the adjustment is transformational. You should not take my word for any of this. Go verify the numbers. Look at the historical silver-to-gold ratio. Look at the inflation-adjusted charts. Look at mining cost reports and production data. Look at exchange inventories and industrial demand projections. Everything points in the same direction. The pattern is visible to anyone willing to look directly at it. And as always, the people who see the pattern early do not just survive the transition. They are the ones who thrive when the window finally opens and the reset begins.